good to have you with us this morning. Let's kick things off with a fresh read on the Canadian economy. If you were watching last hour, Paul Bagnall was going through the latest GDP data. The Canadian economy stalling in August after slightly stronger performance in July. A quick refresher here on the numbers. For July, GDP was up a modest 0.1%. That beat Bay Street estimates. The economists expected a small drop. But Stats Canada's early read for August, putting the economy as measured through GDP at being unchanged last month. So the overall takeaway is that the economy is losing steam after a reopening boom earlier this year. Now, considering the Bank of Canada has been busy ratcheting up interest rates to fight inflation, you might ask, is a cool down a sign that the central bank will also take a break? Well, these numbers on the surface would not suggest Tiff Macklem is ready for a pause, although you would imagine policymakers are going to closely monitor the extent of this softness. As for some of the specifics on what's happening in the economy, we mainly have the July data to work off this morning. It does appear that higher inflation and higher interest rates are slowing down real estate activity. We saw some cooling in manufacturing and construction, not to mention wholesale trade and retail activity. And in another sign of cooling, StatsCan reported today, job vacancies also declined in July by more than 5%. Yes, there are still close to 1 million job vacancies in this country, but clearly our central bank and others around the world are willing to sacrifice the jobs market to a certain extent in their fight against inflation. And just to reiterate where things stand on the central bank front, the Bank of Canada has raised its overnight lending rate by 3 percentage points since March. If that feels unusual, folks, it is. And lots of people feeling that, certainly those in the housing market. Meanwhile, coming into today, Bay Street was pricing in another 50 basis point hike by the bank at its next policy decision that is set for October 26th, so less than a month from now. All right, let's talk a little bit more about the road ahead for the economy and the markets. David Doyle is head of economics at Macquarie Group, one of our regular guests. David, good morning. Nice to see you.
Good morning, John.
What was your reaction to the GDP data this morning?
I think you characterized it quite well, John. It's very much a meandering economy. The third quarter looks like it's going to be fairly weak, something around 0.5% to 1% in terms of an annualized growth rate. That's pretty subdued, and I think what you're seeing is that the economy is stalling after having that significant boost from reopening earlier this year. And I think the other thing important to highlight is that the numbers, at least the headline numbers out this morning, only reflected July. And that's, we've seen the Bank of Canada, they hiked 75 basis points in July, so that probably wouldn't have had that large of an effect on the July data. Then, they hiked by 100 basis points in July, and that wouldn't have had that big of an effect on the July data. But then we've seen them move again in September. So I think it's appropriate to think that there's further slowing ahead, even after what looks to have been a very soft third quarter.
David, can we quantify just how much of that cooling effect comes directly from higher interest rates?
It's tricky to do that sort of analysis, but I think directionally you can say that the components of the GDP by industry do suggest that we are seeing softness in both housing activity and on the consumer side. So certainly you have started to see some impact there. But again, I suspect that you're likely to see a lot more significant impacts to come in coming months and quarters.
And then I guess for everybody who's wondering about where the economy goes from here, so much constant talk about recessions gets a little blurry because a lot of countries around the world are all navigating the same issues right now. But do these kind of trends to you suggest that Canada is either entering a recession, in a recession, or inevitably going to be in a recession?
Yeah, so that's a good question, John. Look, I don't think that we're in a recession just yet, but I do think that one is on the horizon. We see signs of softness sort of across the board in Canada, and typically you see housing start to weaken as you head into a recession, and we're certainly seeing ample signs of that. Our baseline is that Canada will enter a recession in the first quarter of 2023. That will involve roughly a 3% contraction in real gross domestic product, and you'll see about a 5 percentage point rise in the unemployment rate. So we actually think it'll be pretty severe in Canada, and again, that ties back into just how dependent we are on housing and housing activity, and how much weakness we foresee on that front in the quarters to come.
And I guess we're also vulnerable to the ebbs and flows of the commodity market. We saw that nice rally, through the early summer months, and then as the economy worries grew globally, that started to cool off as well.
Yeah, I thought one of the interesting aspects of the data out today was that mining and oil and gas extraction was a strong contributor. So you actually did see some pickup in that activity in July in Canada. And that's a welcome sign. But I just highlight and emphasize for folks that mining and oil and gas investment has declined significantly as a share of GDP. I think if we go back to 2013 or 2014, it was about 4.5% of GDP. Now it's around 1.5%. So it's fallen significantly. There's still some positives coming through from that source, but we're sort of not in the same economy as we were, call it roughly 10 years ago when it comes to our exposure to the oil and gas sector.
David, if the central bank is watching you this morning, you're a well-respected economist on Bay Street. You're now projecting a recession in the first quarter of next year. There is this balancing act, and I get it. Inflation is a constant worry right now. Our Bloomberg surveillance colleagues were talking all about that already this morning. But there is still a Bay Street expectation of yet another rate hike coming next month. What does the Bank of Canada do if more and more economists like yourselves are seeing a recession either right in front of us or in the not too distant future?
Unfortunately, John, I think the die has been cast on this front, and because inflation has become so elevated and unemployment was allowed to fall so low, that I think a recession is almost inevitable at this point. I don't think the Bank of Canada wants to have a recession by any stretch, but the alternative course for them would be to back away from the rate hike cycle at this point in time, refrain from hiking interest rates further, and then they potentially allow for the inflation that we've experienced so far this year to become more entrenched in consumer psychology. And then that would actually force them into hiking even more down the line and potentially create a more severe recession in the future. So while we think there's a recession coming in 2023, unfortunately, we see that as the lesser of two evils. The alternative, I think, would be worse for everyone, both in the near term and the long run.
Well, then I guess my follow-up question is, if they are going to stay committed to this, and so be it, if we've got a recession, are they going to be successful in fighting inflation?
I think so. I mean, if you look historically at the episodes, often when you see a recession, it proves to be enough to bring inflation back down. I think the risk would be, and this is, I think, an important point for folks to be aware of, is that the risk on the inflation side would be that they don't hold their mettle. And when we see the first signs of the labor market deteriorating, which we think could be happening already and may happen in early 2023, that they then start to cut interest rates. That's not my base case or our team's base case. We think that they'll hold the line for a period of time, for at least 6 to 9 months, in order to ensure that they've brought inflation back under control. But the risk, as we've seen Chair Powell highlight, and we've learned this lesson from past cycles, is that central banks, cave too early and they start easing, at the first signs of an increase in unemployment or the first signs of a decline in inflation. I think this time around that central banks are heeding their lessons from the past, and we'll likely see, the end of the rate hike cycle may be on the horizon. It may come as soon, the last hike may come as soon as October, but it will likely be potentially 6, 9, 12 months before we start to see the bank cutting rates again. And that's because they'll want to be certain that they've brought inflation under control.
David, before I let you go, the market's been trying to get its head around everything you just talked about. So after seeing a bounce for stocks in both Canada and the United States off the summer lows, I don't need to tell you what's been happening in the markets recently. And, you've got U.S. markets in bear market territory, a lot of components of the Canadian market that are already in bear market territory. The benchmark index not quite there, but coming into this trading day, down in the neighborhood of 16% from its all-time high. What would be your message to investors who are trying to navigate through all this?
I have continued advice of caution to folks, John. Unfortunately, with the recession on the horizon, I think we've probably got continued struggles ahead, at least in the first half of 2023. Now, we may be, I would say, entering a new phase of the challenging markets, in that the markets may become more focused on what's happening on the growth side and the potential for a recession, versus, I think, up until this point, it's been more focused on steadily rising interest rates. So that focus of the markets may shift, but unfortunately it's not shifting for great reasons away from the fear of higher interest rates, because the new fear, I think, will be about growth, potentially downside risks to earnings, potentially rising unemployment, and all the unfortunate things that come alongside a recession in North America in 2023.